In this lesson, we answer the question that drives everything else when it comes to lease accounting. Is the lease a finance lease or an operating lease? We've established that both kinds now go on the balance sheet, according to ASC 842, but the classification still controls what the income statement looks like. So we have to get it right, and GAAP gives us a very specific test to apply. Let me give you an easy one. Suppose you lease a machine for 10 years and the machine has a 10-year useful life. When that lease ends, the machine is worthless. You've used up the entire asset. You've paid for the entire asset. In what meaningful sense did you not buy that machine? That's the intuition behind classification. Some leases are truly rentals. You lease a delivery van for 3 years and then turn it in to get something bigger. But some leases are purchases wearing a rental costume. The classification criteria are just a systematic way of pulling off that costume. A finance lease is a lease that is economically a purchase. The lessee gets substantially all of the value of the asset, so we account for it like a purchase financed with debt. The right-of-use asset gets amortized, the liability accrues interest, and the income statement shows two expenses, interest and amortization. An operating lease is a true rental. The lessee is using the asset for a slice of its life and handing it back with plenty of value remaining. The balance sheet still shows the right-of-use asset and the liability. Remember, everything goes on the balance sheet now. But the income statement shows a single straight-line lease expense. So how do we decide? GAAP gives us 5 classification criteria. If any one of them is met, just one, the lease is a finance lease to the lessee. The first one, ownership of the asset transfers to the lessee by the end of the lease. That would be in the contract. That's a purchase on an installment plan, plain and simple. The second one, the lease contains a purchase option that the lessee is reasonably certain to exercise. For example, an option to purchase at a bargain at the end. If we're confident you'll buy it, it's a purchase. 3, the lease term covers a major part of the asset's remaining economic life. 4, the present value of the lease payments amounts to substantially all of the asset's fair value. If you're paying for the whole thing, you bought the whole thing. And 5, the asset is so specialized that it has no alternative use to the lessor when the lease ends. If nobody else could ever use it, the lessee has effectively consumed it. 2 of those 5 criteria use deliberately squishy words, major part and substantially all, and in practice, we anchor them with the same thresholds that the old rules used. A major part of the economic life is generally 75% or more. Substantially all of the fair value is generally 90% or more. So here's your working test. Lease term, at least 75% of the remaining life, finance lease. Present value of the payments, at least 90% of their fair value, finance lease. And remember the logic of the list. It only takes one. These criteria are 5 different ways of asking the same question. Did the lessee, in substance, buy this asset? In practice, walk the criteria in order and be explicit about each one. Does ownership transfer? Bargain purchase option? Is the term 75% or more of the life? Compute that one, don't eyeball it. Is the present value of the payments 90% or more of fair value? Compute that one too. Specialized asset? Can it be used by anyone else? If you get 5 no's, it's an operating lease. Any yes, anywhere, and it's a finance lease. One footnote before we move on. If the lease term is 12 months or less, GAAP actually offers a shortcut. The lessee can elect to skip the balance sheet entirely and just record rent expense. It's called the short-term lease exception, and it exists purely for practicality. Nobody wants to present value the lease on a photocopier that you're renting for 6 months. Let's put the checklist to work. Here we have 2 leases. Lease A, a 3-year lease on equipment with a 6-year life, and the present value of the payments comes to about 85% of fair value. Lease B, a 5-year lease on equipment with a 6-year life. We'll walk all 5 criteria for each one and calculate the 2 ratios and classify each lease. In order to apply the lease classification criteria, we need the present value of the minimum lease payments for each of these leases. So starting with the lease A, let's take the present value formula in Excel. We'll use present value, and we're going to grab that interest rate, the 10%. Usually this is something that's written into the lease contract. It's the percentage that the lessor uses to calculate what they're going to charge the lessee for the lease. And the 10% is given to us. Then we're going to grab the number of periods, which is 3. And then we have our payment of $10,000, which I'll make negative because it's a cash outflow. We do not have a future value in this transaction, so I'm going to hit comma, space, comma, and leave that blank. We don't have to owe any money at the end of this lease. It's just the lease payment every year for 3 years. Now, we don't normally have to do this when we do present value calculations because we're usually dealing with regular annuities, ordinary annuities. But in a lease transaction, it's very commonly an annuity due, which means that the payment is due at the beginning of the period. If you think about renting an apartment, your rental payment would usually be due on the first of the month before you live in the apartment. The same is usually true in leases. Pay attention to any problem you're given and whether it specifies whether the payment is at the beginning or the end of the term. But if it's not specified, you can assume that it would be beginning. So I'm going to put a 1 here. It just changes the math a little bit of the present value calculation because we're discounting back payments that are made at the beginning of a period rather than 12 months later or 6 months later, whatever the periods are. So we put that 1 in there and we get the present value of our minimum lease payments of $27,355, meaning that if this were an asset that we purchased today outright, that's what it would cost, equivalent to the payments that we're making over the lease term. So $27,355 is our present value. Now, we're going to go ahead and apply these 5 criteria that are outlined in GAAP. And I've got an acronym here that's commonly used in textbooks and commonly used by Becker CPA prep materials. And it's useful in remembering the rules. So the O is ownership transfers at the end of the lease. This was not given to us. We weren't told that it does. So we can assume no. The written option to purchase at a bargain. We're taking some liberties here with the acronym, adding a W, the word written. It would be something that would be written into the contract, whether or not there was an option to purchase it at a deal at the end. And so we haven't been given that information. We'll assume it's a no. 90% of fair value. So are the present value of the lease payments greater than 90% of the fair value? Let's figure that out. I'll do that in this cell. We'll do equals 27,355 divided by the fair value of the asset. Now, is this more than 90%? No, it is not. So this test is not failed. So the 75% of the useful life test will do the same thing. Is the lease term of 3 years greater than 75% of the useful life? And here we get, it's actually 50%, so that's a no. And the specialized nature of the asset, this would be very similar to kind of the plane question. Is it an airplane? That's pretty specialized. They didn't tell us that, so we can assume no. And so all 5 of these are no, which means this is considered an operating lease. It will still be capitalized on the balance sheet, debiting an asset, crediting a liability, but we will not be amortizing the asset, recognizing essentially depreciation expense over time, or recognizing interest expense. Instead, we'll just be debiting rent expense as we make that $10,000 payment until we give the asset back at the end. Now, the second lease we've got here has a lease term of 5 years and the useful life is 6. We need to calculate the present value of the minimum lease payments based on our fair value of the asset and the lease payment of $10,000 and the interest rate of 10%. So I'll calculate the present value, grabbing that 10% interest rate. Number of periods is 5 years. And we're going to have our same payment as the last lease of $10,000. I made that negative. I do not have a future value. There's no future payment due at the end of the lease. And I'm going to put a 1 here for the assumption I'm making that these are payments we're making at the beginning of the period. That gives us the present value of the minimum lease payments of $41,699. Again, that's what I can assume is essentially the purchase price if I were to pay for it in cash today based on the agreement that we've signed. So ownership transferring at the beginning of the lease, at the end of the lease is a no. They didn't tell us that. There's no information about a bargain purchase option, so that's a no. And then I need to figure out, is this 90% of the fair value, the present value of the minimum lease payments? Am I essentially buying the asset? So I'll take that and divide it by 45,000. And it looks like, yes, it is. In fact, more than 90% of the fair value of the asset is included in these lease payments that I'll be making over the next 5 years. Same calculation here with the useful life. I'm going to take the lease term and divide it by 6. And I get 83%. So yes, it does, in fact, cover most of the useful life of this asset, the lease does. Specialized nature, we weren't given that information. So the conclusion here is that this is a finance lease, and it will also be capitalized, debiting an asset, crediting a liability, but the company will also need to recognize interest expense and then amortize the purchase of that asset over time as an expense. Similar to depreciation, we're going to call it amortization. To wrap up, classifying a lease as a finance lease or an operating lease depends on whether it looks like a purchase. We use GAAP's 5 criteria to determine this. If any one of these is true, it's a finance lease. All no's make it operating, and leases of 12 months or less can skip the balance sheet entirely. Next, we'll work on recording a finance lease from the lessee's side.